Hello and welcome to another video on the channel. If you enjoyed today's video, please leave a like and subscribe and leave a comment down below on what you thought and any opinions and any suggestions for new videos in the future. But without further ado, let's get into today's topic. In today's video, we're going to be talking about financial statements. We're going to be having a look at a few examples of some financial statements and informing and telling you what they are, so you can leave this video knowing a little more about some accounting statements that are most commonly used within business. So what are financial statements? Financial statements are formal records of the financial activities and position of a business, person, or other entity. Relevant information is presented in a structured manner and in a form which is easy to understand. So the reason why we have these financial statements is because your finances must be presented to organisations and bodies such as government when you are paying taxes, for example. So this is why we need them, and we have different financial statements to do different things, for example, cash flows. So let's get into them now. So here we are, a few examples of some financial statements. So as mentioned previously, cash flow statements, balance sheets, profits and loss, and these are the three primary accounting statements you will see in finance and accounting: profit and loss, balance sheet, and cash flow statements. So let's dive into each one of these so we know what each one is and why it is used. So starting off with a profit and loss statement, also called an income statement. An income statement or profit and loss account is one of the financial statements of a company and shows the company's revenues and expenses during a particular period. It shows how the revenues, income, are transformed into the net income or net profit. The net profit and net income being the total after expenses and tax. So the profit and loss statement is looking at the profits and the losses of a company and taking them from each other to calculate the total net profit and net income for a company, usually over a quarter, so 3 months, which is when companies will usually do their financial records. Next up, we have a balance sheet. In financial accounting, a balance sheet is a summary of the financial assets and liabilities of an individual or organisation. It balances assets with liabilities, hence the name balance sheet. And we have a little equation underneath. Equity, so total ownership, equity is equal to the assets take away liabilities, and that will equal equity. So a very simple equation there. So you have your assets, the things you own, the profits, and then you have the liabilities, which is the things you owe, and debts, and you take away the liabilities from the assets to get total equity. So the balance sheet is very important to see how much liabilities, how much debt a company has, and how much assets, how much liquidity it has, how much cash it has, which we're going to dive deeper into in the next statement, as you'll see. But a balance sheet is good to see where a company stands in regards to its assets and liabilities, and balancing it to see the equity they have. Hopefully it's positive equity and not negative equity, and that is the main importance of the balance sheet, so we can see these numbers clearly and see where a company stands. Now the last of these we have is a cash flow statement. It is a financial statement that shows how changes in the balance sheet accounts and income affect cash and cash equivalents within the business. This can also show the total liquidity of the company, meaning how quickly a company can sell assets for cash. So that is the meaning of liquidity. Liquidity meaning how quickly a company can sell assets for cash, how quickly they can get cash in. And that's what a cash flow statement really looks at. It looks at the liquidity of a company. It looks at how much actual cash a company has and how much cash they can get within a certain amount of time from their assets. And it says this is linked to the balance sheet, because obviously on the balance sheet, as you've just seen, we look at our assets and liabilities, and from that we can determine total equity, and from equity we can look at cash and liquidity. I hope that all makes sense to you. We have looked over the three main financial statements in accounting. If you have any comments, please leave them down below. Please leave a like, subscribe if you enjoyed, and if you want more content like this. Thank you for watching, and I will see you in next week's video. Goodbye.